Good evening, everybody. Welcome back to my channel. Yeah, it is me, Cadero Hudson, the wingman, and I am here to deliver that sauce. Yes, I got the fire sauce. You guys all know I got fire sauce. I got hot sauce. Yeah, I got some hot sauce right here. I had some catfish earlier. You know what it is. So, what we talking about today? Uh, we're talking about dividend investing versus growth investing and which one is right for you. Hey, you already know by me being a wingman, I'm here to help you on your journey to make money in the stock market. Yes, I'm here to help you guys to make that sweet, juicy passive income because I'm here on my journey into the stock market and to make money. And hey, I'm here to help you guys in the process to make that money. Yes. Okay, my previous video, I thought I was done, but I had a video, hit a subscriber, recommend a video for me to do. So I just recorded that video about stocks versus REITs and BDCs. We keeping the juice going. We keeping it going. Hey, we keeping it going. Let's not stop. If you guys got any more topics for us to talk about, for us to go over, let's sit down. Let's talk about it, and I'll fire up the webcam and we can talk about it and we can make money. Let's get it. So today, dividend growth investing versus growth investing, which is right for you and which is right for your money. So we got to first talk about uh, which one, the difference of which one of each topic. What is dividend investing? What is growth investing? To really sit down and understand what a you know typical strategy and why you should do it. So I'm a dividend growth investor, and I'm a growth investor. And so uh, I'm not going to be biased. So in my retrospect of trying to figure out which one is good, I have the perks of both, and I have see the good and bad in both, and I'm here to lay it on the line so you guys to be able to do your own research and weigh your options. So what is dividend investing? In the broad sense, dividend investing simply means buying and holding stocks that pay dividends. Next is getting more specific. A dividend investor will typically emphasize on one or more of the following objectives. One, consistent stream of dividend income. A lot of my videos is me going over my dividend portfolio, my dividend portfolio updates of a lot of my stocks and the dividend income that I received in said month. Like, for example, I just recorded a video of the said dividend income that I received for the month of August. Secondly, the growing that dividend income stream larger and larger over time. And then third, realizing a capital appreciation from the stock rising prices from in the long term. So many dividend investors seek to balance these three objectives by investing into dividend growth stocks. Dividend growth stocks, for example, like Lowe's, McDonald's, Apple, Microsoft, ExxonMobil, Chevron, Procter and Gamble, Target, etc., etc. And so right here, and then it gives you an example of dividend growth stocks, but I just gave you an example. Also like Pepsi. I love Pepsi. I don't have it in my portfolio, but I plan on buying Pepsi. So it says what to look for in dividend stocks versus growth stocks. So dividend investors will usually look at several key methods when you are buying dividend growth stocks. And this is typically what I look for as well. I typically look for the free cash flow of the company and the bank statements. I look at the company's short-term and long-term debt, the company's dividend growth rate, which is also called the CAGR, the compound annual growth rate, the dividend history, if the company has had any dividend cuts or just the overall revenue of the company and how much they're increasing its margins, the company's dividend payout ratio, et cetera, et cetera. Right. So the advantages of dividend investing versus growth investing. So dividend stocks tend to outperform growth stocks in bear markets. Like, for example, the reason why I like to invest into dividend growth stocks versus just plainly just growth stocks is that when you invest in just pure growth stocks, like your example, like Tesla, Nvidia, Amazon, Google, uh, in a bull market, man, you're getting returns of 30, 35, 50%. Nvidia this year alone has done, I want to say, over 200, 250% growth. So yes, if you invest like $1,000 or $10,000, yes, your money would have doubled a lot, which helps in regards to making money, right? But the stock market is not a fairy tale. The stock market is not a fantasy where it goes up trajectory up just like this. It goes like this, and it goes down like that, and it goes down like this. And so there's moments where, like last year, where it was hardly. It felt well. It was some green days, but it hardly felt like any green days last year. It really felt like the market was down a lot of months more than it was up. And so even this year, where the market, it was up, and then it's been down, and then it was up a little bit, and then these last few months is like really down, and there's been several days where your portfolio, like for example, I did a video with my dividend growth portfolio was like, I was happy. I was at like 53, 54,000, and then in a span of just like a week, 2 weeks, or 3 weeks, where it was like several days in a row, it was like a negative. It was a negative day, like red, and like man, my portfolio went from like $53,000 to like 48. I was like, wow, yes. And so when you do just growth investing, when it's a bull market, your investment will shoot up. But then when it's like a bear market, your investment it may tank a little bit, and you have to have some, you have to stabilize your emotions so that you don't freak out and sell at a lower pace. And if you're not a mature investor, you'll freak out. And so also another reason, a lot of times people like myself are dividend growth investors, because we like to receive the cash from the dividend stocks in our dividend portfolios, and then there's no need to sell the shares. So typically, when you buy uh, stocks or whatnot in your 401k, you're buying the market. You're buying, let's say you're buying the SP 500. You're buying VU, right? So you buy VU, you're buying shares, you buying whole, and then you're waiting 25, 30, 35, 40 years into the future to sell those shares. But dividend growth investing, we are accumulating these shares so that our golden goose is producing these golden eggs, and we just sell the golden eggs, which is the dividends, compared to having to sell the whole goose or gander, which is the actual dividend stock. And then also, lastly, dividends are taxed at a lower rate versus earned income, which is when you hold the dividend for 90 days, your dividends are become qualified dividends, which depending on how much you're making and how much you make, can be from 0% to 15%, which is not bad. So, what are the disadvantages of dividend investing versus growth investing? And so, although dividend payments receive preferential treatment, tax treatment, you still got to pay taxes. Still got to pay taxes on those dividends. So whenever you receive dividends, it's you're receiving income. And so basically, let's say you made $50,000, $60,000 that year at your job. If you made $10,000 in annual income from your dividends, now that year you make 70,000. So you still have to pay taxes on that $10,000 of dividend income, even if you decide to reinvest those dividends. So sucky part, but it's all part of being a grown up. Companies aren't required to pay dividends, so a lot of times, a lot of stocks where a lot of people invest into, they thought that, hey, uh, the stock going to pay dividends forever, like AT&T, and AT&T cut its dividend, and NPW, I think like a medical REIT, just recently cut its dividend. Uh, Back in 2020 with COVID, Disney pauses dividends. So a lot of times they say it's better to invest into the index fund like VU, VTI, because a lot of times just by investing into just certain stocks, it is risky. I'm not gonna lie, just like investing in cryptos, it is risky. So growth investing. So it's time to turn attention to growth investing. What is growth investing? Basically, growth investing is all about capital appreciation, capital appreciation is the primary focus. So, unlike value investing, buying stocks that appear to be trading at a discount, growth investors care less about stock valuation. Thus, they will buy stocks that are expensive on a stock price to company earnings basis. And so it says different from dividend investors. A growth investor does not care if a stock pays a dividend. So you're buying Apple, you're buying Tesla, you're buying Google, you're buying I think I said that. I think I said Amazon already. It's another company that's on the tip of my tongue. Meta, Facebook. You just buying these shares, You hold it, you hold, and as a growth investor, you're waiting for in the future. So that if you're buying at, $100 a share, $125, $150 a share, you're banking that this company is going to be making a lot of money. It's going to be profitable. So that in 10 years, 20 years, 25 years, you want to sell it at $1,000 a share, $2,000 a share. Or if the stock split, boom. Now you started with 10 and the stocks do a two for one split. Now you got 20 shares. And then guess what? If the shares begin to, appreciate again, and now it goes from 150 to $1,000 per share. Now instead of you had 10, now you got 20 shares because of the stock split, and now you got 20 shares times $1,000. So that's the whole point of the growth investing. But with the growth investing, don't even have to go through these. Right here, right here it says Tesla, Amazon. Only the thing is with growth investing is that when the stock market have its good days, the Apples and the Microsofts of the world, hey, all tides raises all boats. The whole stock market goes up. Like Nvidia, for example, a couple months ago, and because the whole AI boom, Nvidia began to do well. Boom, it appreciated by a lot, right? Which let's talk about the stock, right? The stock price hit appreciated. Let's talk about it. So the stock price hit appreciated by a lot. So starting at January of this year, the stock price was at $156, right? And then boom, you could see where the AI news came into play right here because that is a big jump. So it was trotting along, and then the whole AI news came out how it was doing well. It shot up, boom, and then shot up. So right now it's at a price of $485, but at the beginning of the year it was at $152. So let's say that for Christmas, what if you would have bought yourself or your daughter or your sons or whoever shares of NVIDIA just as a gift, right? And you would have held those shares at the beginning of the year already. If you'd have bought those shares for yourself or your loved one at $142, now basically your shares have what doubled or more so like two and a half. Like that's crazy already. That's right now. Imagine holding it for 5 years, for holding it for 10 years, 20 years. So that's the power of growth investing. But also the disadvantage of growth investing is this: if you right here, if you would have if you catch it in buying these stocks when it's already at the top right here, if you'd have saw like, okay, I got a FOMO, fear of missing out, right? Boom. If you'd have bought it, my computer is acting up. If you'd have bought it right here, it was at 467, right? And then guess what? On August 11th, it went down to 408. Then you would have lost money. But then if you stay patient, you see right here, it went up to 485. So a lot of times with the whole growth investing, depends on what time you buy the growth stock. You just gotta hold, even when it's those bad days or consecutive bad months, whatnot. You just buy and hold, and you're betting on a profitable company, a profitable horse, and that is going to be profitable. So that you see this curve, you see on the fire basis that right here. So it's right here. If you bought it right here in 2022, then you'll be like, okay, cool. But then what happened? Going into 2023, it went down from $300 to $131. So that's a full year. And so you have to you would have had the stomach to hold NVIDIA and not sell it, because guess what? going from the end of 2020, end of 2022, from 2023 to now is up. And so there, along the way, when you do growth investing, it is rocky. And then I decided to do a growth calculator. So with this growth calculator, when you invest into growth stocks right here, I did 20 years. This is if this is a solid upward trajectory. Now we know that with growth investing, depending on how well the stock market is doing, you would not receive a solid 30% annual rate every year. But like so, for example, Nvidia is up 250% this year, but last year it was down. What it was down probably 10-15%. And so, yes, if your Nvidia's price, but if you started with $1,000, if you used to spend $500 per month, yes, but then 20 years you'll be at 3 million, or let's say in 15 years you will be at 1 million. But at the same time, you will have to when it's those good years, when it's a bull market, you still have to buy. And then when it's like last year, as you see, when it's like last year, when the market is down, you would still have to put the $250, $500 per month and buy the shares while it was at this lower price. Because then once it goes up, those shares that you would have bought at a lower price all would have appreciated. But again, as an investor, a lot of investors are way more comfortable with investing when the stock market is green and it's a bull run. But when it's times like now where it's a bear market and you don't know, hey, it's the stock market is going up, are we good? A lot of times when it's uncertain, a lot of people like to clinch up and keep their money to the chest, and if have fear like, oh, I don't want to lose my money. So it all depends. When you are a growth investor, you have to really be comfortable with the risk and invest, buy it, and just walk away and don't even look at it. And so right here, I have an example of a dividend growth stock. It's more so a growth stock, but I mean it's more so a growth stock, but that pays a dividend. That's why I like it. But it like for example, compared to Nvidia, year to date, this stock is up 57%, which is unheard of compared to other dividend growth stocks like McDonald's or a Target. And so year to date is up 57%, which I love. I have 5 shares of Broadcom, and I decided to go through example because I'm comparing growth investing like to a growth stock compared to a dividend growth stock. And then I did the same thing. It costs $872 a share. You starting out with 1 share. It has a dividend increase of 12%, appreciation 20%. Did 20 years, right? And so you saw with the growth stock after, which is, I think that's kind of unfair. Oh, I did the same thing, 20 years. So I did the same thing. So with 20 years, with the growth stock, it was like $3 billion, right? So right here with the dividend growth stock, 20 years, the ending balance was 1.2 million, right? And so, but then what you like about this is that it's 1.2 million, but then this would also be paying a dividend. And so right here, it would have been a 961 total return, and then right here would have produced a annual dividend income of $6,825. And with this $1 million, I mean, honestly, you could just sell some of the shares. You could sell some of the shares and then invest into a high yielding stock. But the reason why a lot of people like this is because you are receiving dividends. You are receiving dividends along the way. And so even when in those down markets where like last week where it's like the market is down, whenever it's time for Broadcom to pay his dividend, you pay his dividend. Compared to Nvidia, when it's a down market, it's sliding 20-25%. And now if you bought it at 300 and now the new price is 250 or 225, Now you have a stock that's like it's lost a lot of its value and it's not paying a dividend compared to Broadcom. The dividend by paying the dividend is added to the actual yield or the value of the stock for those total returns. So that's why a lot of dividend growth investors like myself like to invest into dividend growth stocks compared to just purely growth stocks because, man, when the market is down and the market is sliding, it really helps and really beneficial to receive those dividends. So, which is better, dividend growth investing? I say do both. Uh, I like to do the growth investing into my traditional IRA, and then also for my company's 401k plan, buying the market, buying VU, buying VTI. In my traditional IRA, I like to have VTI, so for the growth, but then for my taxable account, I love the dividend growth investing because also I like to invest into single stocks like Microsoft, Apple, Lowe's, Home Depot, McDonald's because of those dividend checks. Because I also would like to retire early. I would like to retire at 50 years old. And when you lock a lot of your money into the uh, retirement accounts, you're not going to be able to take your money out until at least 59 and a half. And so if you have all your money into your 401k, into your traditional IRA, if you wanted to retire at 50 years old, 45, 52, if you take the money out of those retirement accounts, you get taxed double. You get taxed the 15%. You get taxed the penalty for taking money out. Compared to if you started at age 25, 30, and you invest in your Roth IRA, of course, invest in your 401k, but then you also built up a taxable account, then now the money that you've been growing in your taxable account, let's say you got up to 500,000, 750,000, 1 million, and then guess what? Let's say that now you have annual dividends of 30,000, 40,000. You can take that money and then you can go live on it compared to having to wait to 59 and a half. So that's why a lot of people, they do the dividend growth investing, buy single stocks, put it in a taxable account, and then also do the growth investing with their 401k, and then also in their taxable account, invest into either growth ETFs or S&P 500 or invest into QQQ for the NASDAQ. So I don't know which one is more beneficial for you. I let that be your example, but I went through examples with NVIDIA and the Broadcom. I like to do both. I'm high risk. I love I love the high return stocks like Eli Lilly and NVIDIA, crypto, Bitcoin, Ethereum, but I also like dividend growth stocks like McDonald's and Apple. So if you like this video, hope you enjoyed this video, and yeah, enjoy you guys' Labor Day. Peace.